Welcome everyone to my next banger investment video. As you can tell from my previous uploads, I've been addicted to playing games these days, and that is why my investment guide uploads are slow. And for some reason, my gaming video gets like way more views than my investment videos, even though my viewers can make money by watching my investment guides. But anyways, as you will know from my self-introduction video, I achieved a 34.8% CAGR for the past 5 years, while the S&P 500 achieved about 15% CAGR. And a majority of my success comes only from investing in shipping stocks for the past 2 years. So recently I had some temporary motivation to make this video, and I'm just gonna capitalize on this temporary motivation to share with you my guide to invest safely in shipping stocks. But first, as usual, you must know accounting because you can only profit from stocks by understanding accounting. Next, let me show you some credentials on why shipping stocks is in my area of competence. I first became interested in shipping stocks back in 2021 because I invested in a company called Rocky Brands. My net worth as a 21-year-old student that time was $12,000 USD, and this investment was like a 3.5k USD, which shows you that this is a substantial part of my portfolio, and I put my money where my mouth is as an investor. I make big investments and I profit from it. And I bought this company at $25 to $26 per share and sold it at $48.50 in 2021 and also $39.70 in 2022 when they said they will have low profitability from high shipping costs to ship its goods. And then the young me thought, oh wow, if this company is getting screwed in the ass by high shipping rates, then that means that shipping company must be making good money. So during that time until now, shipping remains as one of the most undervalued industry out of all US stocks, and I decided to learn and invest in shipping stocks. Along the way, to understand shipping stocks better, I was lucky enough to work as a research analyst with a top-tier maritime shipbroking and consultancy company called Clarksons for 1.5 years. While working in the company, I also invested in this company called Imperial Petroleum at $1.80 per share in 2023. And I sold it at $3 plus per share in 2025, which is like a 100% return in 2 years. So this should show my competence in shipping stocks since I've made like good money of it. So now with my actual credentials proven, I'm going to share with you my framework to invest in shipping stocks for you to make money. First, you need to understand the cyclical nature of the shipping industry before you understand the shipping companies themselves. You make money off shipping stocks when the shipping company earns a lot of money, and a shipping company earns a lot of money from high shipping freight rates. Freight rates refers to the amount of money you can get for making one voyage. And to understand the profitability of shipping companies, first you need to understand the cyclical nature of the shipping industry. When the economy is booming, you get high shipping rates and a lot of money for free. When the economy is dying, you get low shipping rates and you lose money because your ship can't get business and sits idle down there. One good example is to look at freight rates during COVID lockdown, whereby the ships don't have any business because everyone is stuck in their homes and nobody is using ships to deliver cargo. Then you look at freight rates after COVID is over and you see way above average freight rates for the next year. Think of shipping freight rate cycles as an economy cycle because it ties closely with the economy cycle's ups and downs. The next industry characteristic is that one shipping cycle typically lasts for 7 years on average. And this source is from Maritime Economics and the textbook itself. And take note that shipping cycles never last exactly 7 years. Some cycles will last for 10 plus years, and some cycles only last for 2 years. So when you average out these cycles, it actually turns out to be 7 years. Just like how if you average out a McDonald worker's salary and Bill Gates' salary, then the average salary will be a lot of money per month. Okay. Now I want to go off track a bit and yap about why does some shipping cycle last for 10 plus years? The answer is very simple. It's because of idiot speculators. As you can see here from 1979 to 87, the bulk carrier rates were at an all-time low. Then people thought that all-time low equals to, hey, the rates can only go up, so let me build more ships. And you can see everyone around you building more ships and building more ships even though the freight rates are low. This sort of dumb speculation to build more ships when others are already building ships in a low freight rate environment leads to extended down periods. So, the moral of the story is when you notice dumb speculation, don't invest. And the next industry characteristic is that shipping freight rates are controlled by the demand of cargo rather than the supply of ships. The supply of ships will always be an after effect from the demand of ships. To break it down for you, the demand of shipping will always be relevant to the demand of your ship's cargo. For example, oil tankers demand will always based on oil demand. And for the supply of shipping, it will always be equals to the number of ships available to deliver the cargo. In typical economics, you are taught that demand and supply will control the equilibrium price of the market. However, in shipping, a low supply of ships does not guarantee high freight rates because freight rates will not move if cargo demand is still low. But if cargo demand is high, it will always guarantee a high freight rate. Why is shipping rates like they are solely controlled by demand? That is because current cargo demand fully controls the future supply of ships. I will ask you two questions. Can you predict whether the Middle East OPEC is going to produce a lot of oil tomorrow or produce no oil at all? Meanwhile, can you foresee easier whether the number of oil tanker ships will be a lot in the next year compared to past average levels? Future oil demand is impossible to predict, but the number of oil tanker ships in the future can be predicted based on the current oil demand. Because people will build ships if the demand is high, and therefore the number of ships will be more in the future. As such, a typical shipping cycle goes like this. High cargo demand leads to high freight rates because the current supply of ships is not enough to supply the cargo demand. And more people buy second-hand ships to enter the market ASAP to profit from high freight rates. Second-hand ships increase in price so much so that it is more worth to build a new ship instead of buying a second-hand ship. And the number of new building ships start to increase like crazy. The price of the new building ships also increase like crazy because of high demands for all the shipyards to build new ships at once. And these new built ships then take 2 years to build and flood the market all at once, which results in high freight rates crashing down to all-time low. From this, you can see that cargo demand fully controls the future supply of ships. And one notable point is that high freight rates will always crash down to all-time low levels after new building ships flood the market because people will always build a new ship when the current freight rate is high. And when the freight rate crashes down to average level, there are already more new building ships in the middle of building for the next 2 years, and this results in freight rates crashing even more in the next 2 years, even if people stop building right now. Next, the final characteristics is that ships typically have an average life of 25 years. Yep, that's it. No additional explanation at all. That is all. So now you have understood the cyclical nature of shipping industry. Let's now move on to evaluate shipping stocks. Typically, you will want to own a stock whereby the freight rates are recovering from below average levels because this is when the stock finished crashing and is recovering. However, it is impossible to predict when exactly will freight rates recover because you can never reliably predict cargo demand. So you don't have to buy the stock at its lowest. Just buy the stock at relatively low levels, then have the patience to hold until freight rate recovers and go back to the peak. Of course, always re-evaluate fundamentals such as cargo demand and supply of ships to determine whether future freight rates will increase, decrease, or stay the same. Okay? You also want to own a company whereby the top management can convert high freight rates into high profitability. I shit you not. You would think even the biggest idiot can make money from high freight rates. But here is an example whereby container ship rates are improving and increasing, but this company actually manages to have a 93% drop in net profit on improved container ship rates. So avoid companies with idiot management that cannot convert high freight rates into profits. Shipping companies also typically operates in two manners. First is to build the new ships from scratch, or next is to just buy second-hand ships. Both manners have its own like pros and cons, and no one is more superior than the other. However, in general, building new ships will cost more than buying second-hand ships, and when shipping company needs capital, They will either borrow debt or issue shares like crazy. You absolutely want to avoid companies that raises money by issuing shares because shipping companies are typically largely owned by a private owner, which means they represent majority shares ownership and they can ignore minority shareholder interests. So minority shareholders like you and me will get milked by these major private owners if we are not careful. And only shipping companies have the tradition to raise money by issuing shares, and that is why shipping stocks price to earnings ratio will always be low, and you will be wise to avoid such companies. One real-time example is this company called C3IS. They issue shares like crazy, and then their stock price crash, and they reverse split to have a share price above $1 per share to remain listed in the stock market. Then rinse and repeat. If you own their shares, you'll be milked by the repeated crashes and reverse split. Okay. Finally, I will recommend you to evaluate shipping stocks by solely PE ratio, then their book value, unless you can buy over the shipping company entirely. A lot of shipping stocks sell way below their book value per share because the stock market treats the value of ships as worthless because of how the huge freight rate crashes in the shipping industry. You can also watch my video about my stock valuation method to calculate the share price of a stock. But in this case, just focus on net income per share and don't use book value to evaluate shipping companies at all. Below is my theory on how the market values shipping stock. If the company is profitable, then you use PE ratio. A PE of 2 is normal in the shipping stocks. A PE of 4 is overvalued. That is because investors tend to avoid shipping companies like crazy when they issue shares. And it's part of the tradition to issue shares. And that's why this industry will always have a low PE ratio. If you can become an activist and take over the company, then just buy the stock at below second-hand ship liquidation value. Why? Because if you buy the company and you sell their ships at second-hand prices right now, you get all the cash back. And if the cash that you get is more than your investment capital that you put into the company, then you will profit. And by the way, a 10-year second-hand ship typically costs 50 million. This differs based on ship size and age, but this is the most conservative way to calculate book value across all second-hand ships. If the company is not profitable, then value the company based on the scrap value of ships. Ships are scrapped after a ship is generally older than 25 years and is too old to be used. A conservative scrap value of a ship will typically be around $4 to $5 million. Here is an example of a not profitable company. So if a company is not profitable like this company below, then you can see that across many years in the stock price and in this valuation, the market is valuing the company as if their ship is only worth scrap value rather than second-hand value. And you have come to the end of my modest guide to invest in shipping stocks. Hopefully this is useful to you to profit from shipping stocks. And remember to subscribe to my channel and leave a comment if you like my video. And I'll see you in my next video. Peace.